In this session, we will be dealing with private equities, their characteristics, as well as the various valuation methods that are involved in the private equity companies. Whenever we talk about private equity, it is an indication of two major types of investments. One is a venture capital investment, or it could be a buyout. And in both these forms of investment, some capital is invested in a private company. That is why we call as private equity. It's not a listed firm. It's not a public company. In a private firm, an investment is being made, and for this particular investment, an equity stake, it's not a loan that is provided, an equity stake is being taken by the private equity investment firms. So the money that is typically invested by private equity firms is into various private companies. They invest in various private companies and take an ownership stake in each one of them, and take an equity stake in each one of them. Probably the management for each of these companies may exist separately, but from a financing standpoint, this private equity firm will invest in these companies and have a very significant controlling stake as a part of this investment. So if they do this investment in very matured, highly established companies, and probably buy out their public equity stake and convert them into a private, because this investment is purely a private investment. So if because of this investment their stake goes really higher and a public firm is getting converted into private, we call those kind of companies typically as buyout firms. Whereas if this amount is invested, if these companies primarily are new startups kind of companies, and this capital is invested in these companies for an equity stake, we call that form of investing as venture capital. So whenever we talk about the private equity investment, they have to go into one of these two categories, either investing in a very established company and turning it from a public limited to a private limited. That is what we call as a buyout firm, or a new technology startup kind of firms where this kind of investment can get in. They are typically classified as venture capital investment. Both of them come under the category of private equity investments. Now, how do these private equity firms, here we have to differentiate between two words. One is private equity firm, the other is the portfolio company. Here when I use the word portfolio company, these are the set of companies where the private equity firm typically invests. These are that particular companies where the private equity firm has invested. They go as portfolio companies, and when I say private equity firm, or sometimes we use the word private equity fund, because many people might have contributed a capital which is invested in various of these portfolio companies. So we call that as private equity fund, which is managed by private equity firm. But whenever we use these words, it is more associated with the capital, whereas when I use the word portfolio company, we are talking about the companies, private companies where this particular capital is invested. So some of the ways these private equity firms derive the benefit out of their investments is one, they have the capability to do a re-engineering of each of these companies. When I say re-engineering, they can work with the business strategy, they can change the lines of business of the products, they can kill some of the products and continue some of the product lines, they can aggressively promote some of those lines of business, they can do all kinds of operational restructuring. They have very high profile people as a part of their team. Generally a good private equity firm, apart from the capital, they have very experienced and high profiled people probably who might have worked as CEOs and CFOs of some other companies earlier. So with that kind of an expertise, they can really get into the restructuring of the firm where they are investing. So if they are investing some capital in each of these three firms, they can restructure the business, restructure the operations so that exceptional performances can come up, exceptional profits can come out of those firms. Means they generally identify firms which have a potential to perform in case they are restructured properly, and based on that they try to invest in those firms. They have a very high qualified team who can get into the successful restructuring of the firm's process. But this entire restructuring is a very tedious exercise. So predicting the future cash flows is highly uncertain because it all depends on how successfully they are restructured. So as an external analyst, it becomes very difficult to really understand what could be the cash flows because of this restructuring exercise. So the valuation using the discounted cash flow kind of an approach, or any of those approaches which find the present values of the future benefits and all, any proxies on those lines will become very highly difficult to evaluate a private equity investment. But one thing we have to appreciate here, one strong way the private equity investors derive value out of their investments is they have the flexibility as well as the expertise to restructure the existing firm and generate the highest possible profits which they are typically looking at. And the second way they typically operate is through a heavy usage of leverage. They have very good access to the debt financing because of they pay their debt on time. So from their risk assessment perspective, they fall into a very least levels of risk. So they can use the leverage, and because they are very considered to be very less risky, the cost of debt is much lower for them. So the overall cost of capital comes quite at a much lesser rate, which means the scope for generating the returns will increase quite drastically. So they can use debt quite effectively, because a public limited firm will have the problem in terms of using the debt heavily, because equity investors will treat it as very high risk. Whereas when it comes to this private equity, you don't need to really go to each and every very small time investor who would be looking for immediate returns. Whereas when you look at a typical private equity investment, the equity investor should typically look out for long-term returns, nothing much in the shorter terms. So from that standpoint also, it makes a lot of sense for the company to use debt more effectively and get an advantage with respect to cost of capital, which will help them to generate higher returns as the time period progresses. And most of the times what happens is the debt is in the form of either syndicated loans or high yield bonds. So various banks come together to give them a loan, or the company itself issues high yield bonds, means like junk bonds which have very not so high credit ratings. So which means they end up giving higher returns as a part of the high yield bonds that they are issuing. But the advantage is both of these, whether it is a syndicated loan or a high yield bond, both of them are secured in the way they are repackaged to create either a credit, either a collaborative loan obligation or collateralized loan obligation CLO or collateralized debt obligation CDO, resulting in a huge transfer of risk to the third party special purpose vehicles. So from that dimension also, though they issue the loans, though they issue the bonds, or though they raise the loan, they are highly secured by they are highly secured. So which means they can access the capital quite comfortably. But yeah, very recently, of late, after the great financial crisis, it has been observed that debt financing for buying out the equity of or complete purchases or for buyout transactions, that access to the debt capital has slowed down. So most of the times, even today, the buyouts are there, but buying out at a very high leverage, that kind of mechanism had significantly reduced. But that is one more way a private equity firm differentiates itself from a typical public equity investment. And the third thing is, with respect to public equity investments, we have seen there is a very high possibility of the principal agent problem. But here, to a large extent, the PE investors try to align their interests with the interests of the managers of the portfolio companies. We'll see there are various ways in which the PE investors take care of the managers of the portfolio companies. In some cases, it goes more in terms of benefits to the portfolio company managers, and in some cases it is more on the restrictions from their side. Whatever is the various mechanism they are typically getting into, they try to align the management's interests with respect to their own interests, making sure that there is a win-win situation and a significant generation of profitability in the company. So the PE firm, they keep the stake of the management to be very high. So management has to work to actually increase their stake in the company. So management, a lot of benefits of the management are tied with the performance of the company rather than a fixed salary kind of an approach. Apart from that, the PE firm itself offers the management expertise, because it is having a lot of people with very solid backgrounds. So it itself can offer high levels of management expertise to the portfolio company, and it even comes out with a clause saying if the management company fails to deliver as per the targets, the portfolio, the private equity investment company can even control the operations of the portfolio company also. Even such kind of clauses could be there as a part of an agreement. And as I have already indicated earlier, there is a possibility that the managers of the private equity invested portfolio companies can focus a lot on long-term capital projects also, because day-to-day shareholders pressure and third-party analysts ratings and rankings do not apply to any of these companies. So, and that too, this company is more of a restructured kind of a company. The management has more and more flexibility in terms of implementing projects which may not be profitable immediately but may result in high levels of profitability in times to come. So that's where it is. One more thing which I can mention here. Most of the time we see this private equity investments are allowed for only highly qualified investor. And when I use the word qualified investor, it could be in terms of the net worth. Probably someone who has a net worth of minimum of 1 million or something like that. Only these kind of people can invest in the private equities. Whereas when it comes to a public equity investment, even a few hundreds of dollars or even a few tens of dollars can be invested to purchase a few shares. So that is one more place where we can see that because of such kind of huge investments being made, it is even expected that the investors have to really wait for longer periods to really see that their investments turn highly profitable, because the identification of appropriate opportunities and selecting them for investment is a challenging task for the PE fund managers. And as I have said, most of the times the private equity fund manager, they try to align their interests with the portfolio managers of the portfolio companies. Some of the mechanisms which I observe they heavily follow is they link the compensation of the management. They link the salaries of the management to the company's performance. It's not a fixed salary approach. It is purely based on the company's performance, and any increments will come purely based on the company goals, exceeding company goals. So that is what will typically come out. So which means it makes the management work to earn something more. Then the private equity firm can even take the representation in the board of the company, especially if the company wants to go for a takeover or IPO or any other restructuring exercises. The clause will typically say that private equity firm can take the representation on the board if this portfolio company is looking for any of these kind of scenarios. Then the agreement can also contain a clause called tag along, drag along kind of a clause, which says if suppose, okay, this is a PE firm which has invested in this portfolio company. Let's say if this portfolio company is approached for acquisition by some other acquirer, whatever the deal that is coming out, it goes equally to the entire investors as well as the management. That benefit of acquisition has to be passed on not only to the portfolio fund managers, but the entire thing applies to shareholders as well as the management of the firm. So it makes the managers of the portfolio companies a bit more cautious before they get into selling off the company to a potential acquirer. And a few more clauses typically come up. So let's say if the founders of this company get out and start a parallel company competing with this, the non-competing clause says the founders of this company cannot start a competing company at least for some years after the investment of the PE firm in this company. For a few years, this kind of competing business cannot be started by the founders of the original, which means the people from here, they cannot try to drown this company and start up a parallel company in its place. Then, from the return standpoint, the private equity firm tries to get into the, they try to invest in the form of preference shares. Most of the times the PE investments are in the form of preferred dividend or preference shares, for which they typically receive preference dividends, and also at the same time, in case of any liquidation, they have the priority over the original investors or over the management, because they are investing in the form of preference shares, and generally their preferred dividend is also a kind of fixed, which would be some kind of a multiple to their original investments. That's also one more way they control the operations of the firm. And any major restructuring exercise, because the PE firm takes the representation in the board, it needs even an approval from the PE firm. And this is an interesting aspect, the earnouts. Whatever the acquisition price, whatever they are paying, whatever the PE firm is paying for investment in this portfolio company, it is tied to the future performance over a specific period. So if I am paying you $100 million to acquire some percentage stake, it is linked to a minimum level of performance. It is expected that you have to generate at least 5 million in terms of earnings every year. Such kind of link up. In case you are not able to generate, then probably we can draw back some particular amount from the company. So such kind of earnout kind of clauses also could be there as a part of exercising control over the management of the portfolio company. So various tools are typically being used by the PE firm to exercise control over the portfolio management company. Then, as I said, the typical two major investments which a PE firm or PE investments can be classified into are venture capital investments as well as buyouts. When I talk about venture capital investment, they are trying to invest in mostly in the startup kind of businesses where the competition is not so heavy. It's a new business idea and the firm is very less matured because the idea came up very recently and no other modes of funding is available. And at the same time, the investor doesn't know whether this idea will be a success or not. So, such kind of firms, if they are coming out with very new business ideas, they are treated as venture capital firms and the investment in those firms is going as a venture capital investment. So, generally they are less matured, but the entrepreneurs will have a very targeted industry focus. Generally only in some upcoming industries only these kind of investments are possible. Then because of a novel idea and all, predicting the future cash flows is very difficult, and even coming out with realistic projections is also very difficult. And the product market, the acceptability of the product and all are also a very tough exercise, because everything is based on new technologies, so prospects are uncertain and the company does not have much of asset base at all because it's a new firm, majorly driven by idea rather than a huge asset base. Even the management team is very new. Probably they must be having experience in various other companies, various other businesses, but as far as this business is concerned, the team is pretty new, so there is a huge risk associated with it, and they cannot get access to good debt capital because one, the asset base is very low and the company does not have a sizable history. So whatever that minimum amount of funding that is available in the company is purely in the form of equity. And the exit mode, how to exit this particular business is entirely very difficult to predict. In some cases, within 3 years, the growth can be very drastic, whereas in some cases, even after 10 years, the growth may not be that significant. So, when to exit and at what price to exit are very challenging with these kind of companies. There is a heavy probability of failure that is associated. Some firms may succeed very heavily, resulting in high returns, whereas some firms result in heavy write-offs, resulting in a big failure. So the investor who is targeting these kind of firms has to be prepared for either of the results coming out of the investment. So from that standpoint, the risk is very high. So the return expectation also will be from that kind of a dimension. The working capital requirements are very high because the company is in a very initial phase, and if the idea takes off, the growth is going to be tremendously large. So, so from an investor's perspective, a heavy amount of due diligence. Any PE firm which is trying to invest in such kind of firms has to do a very heavy due diligence with respect to the feasibility of the project from an operational standpoint, commercial standpoint, and various other aspects. And for this, from an investment perspective, there is no active capital market, because if I want to sell off this firm to someone else, it's very difficult for me to sell it off. So there is a huge amount of illiquidity that is associated with this kind of an investment. And major focus from an investor is how heavily are the revenues of this company going to grow. Rather than the profits, the focus is more on the growth in the revenues. The higher the growth in the revenues that are associated with this firm, the higher will be the investment levels with this kind of venture capital firms. Whereas on the other side, when we talk about a buyout firm, compared to the venture capital firm, we see that the cash flows are more and more predictable, because buyout firms are typically those firms which were highly successful in the past, but today they are slightly stuck up because of lack of funding. So, or probably some firms which were successful until in some businesses, but today they have an asset base, but they are not able to compete in the newly evolved kind of business world. Those are the firms which are targeted by the PE firms. So those firms already have a very strong market position and all. Their asset base is very strong, management is good enough, but probably the product market in which they are operating is slightly obsolete, or some kind of renovation or re-engineering of the product base has to be done. So companies which are more at that stage typically are targets for buyout market. So they can, because of a very strong asset base and all, they can be heavily financed through debt, because the company can raise a loan, the PE firm can raise a loan against the debt of the portfolio company, and typically against the assets of the portfolio company, and because of that heavy debt financing is very much possible. And if at all using the debt, if the equity of the portfolio company is is purchased, we call that mechanism as the leveraged buyout kind of mechanism. I am using leverage based on the asset base of the portfolio company to buy out the equity stake of the portfolio company. So that is what we are calling as heavily financeable through debt. Exit strategy can be easily predictable. Probably within 5 years, 10 years, I want to transform the company, I want to re-engineer the company, generate the required profits and exit out of the investment. So most of the times for a private equity investment, the exit value as well as exit time period is generally predicted with a better accuracy compared to a venture capital investment. Because these firms are established earlier to a large extent, the success rate is much higher compared to venture capital investments, and probably there is a good existence of active capital market also. In case I want to sell off my stake to someone else, it is very much possible comfortably compared to that of a venture capital investment. So from the perspective of the investors, for a buyout firm, the emphasis is not on the revenue growth, but it is more on the EBITDA growth. How interestingly, the revenues minus the expenses, which is the profit, the rate at which it is growing, is the major thing that is evaluated for an investment in the private, for the investment in the buyout firm. So that's how we can differentiate a buyout firm from a venture capital firm, though both of them come under the category of the private equity investments only. So now coming to the next important aspect with respect to these investments, how do I value these investments? There are multiple methods that are available to value the private equity investments, right from the discounted cash flow methods, of course applicable only to a few. So when I talk about a discounted cash flow, we all know the process. I predict the future cash flows and discount them to the present value using a cost of capital. Here, if I have to predict the future cash flows, the historical performance need to be known. Some expectation on how the future cash flows are going to be should be known. So generally what we say is this method is applicable for companies which have performed decently well in the past. So maybe a good criteria for buyouts, but it is definitely not a good mechanism for venture capital investments, because the cost of capital has to be estimated, and sometimes what people do is they try to estimate the cost of capital based on the public companies which are comparable, using the pure play method, adjusting the beta of public companies using the leverage as well as the tax rate of this private company, and along with that they can even apply a few more discounts for illiquidity or non-marketability compared to a public firm. So all these things are discounted, and finally the beta is arrived at from their cost of equity and from their cost of capital. So that itself is a very tedious process, and even this also requires finding out the terminal value, means the value at the time of exit. Generally this is estimated based on some multiple of EBITDA. Even that means if at all I have to give some multiple to the EBITDA, again it comes as a challenge that a firm with a good operational history, you can do this kind of prediction quite comfortably compared to a completely new firm. So though you can use the discounted cash flow mechanism, it is seen that you apply it only for highly established and the performing companies which have done successfully over the last few years. Whereas on the other side, you can look at a second method of valuation, which is exactly on the same lines as valuing a public equity, where I can use relative valuation approach using multiples like P by E, price to book value kind of scenarios. Again, if I have to use a better comparable, or if I have to know these are the companies which are competing with this particular company, again I need to have a good operational history, otherwise the comparables itself may be very much not so appropriate. So identifying a public listed company which is having a similar kind of characteristics of this kind of a private company is very difficult. So even applying a relative valuation approach becomes much difficult. The third mode of the third mode, which is a real option kind of an analysis, which has been discussed very heavily as a part of our corporate finance module, that can very well be applicable, because most of the time private equity investments have some probabilities of success as well as some probabilities of failure, and because of that, finding out the NPV in each of the various scenarios, and then using the exit options, trying to find out what is the actual worth of the company in case there are intermediate exit options, is another better mechanism to evaluate the private equity investments. The other thing is a replacement cost, generally applicable to the newer companies itself, because existing companies which have a considerable amount of assets which are productive kind of an assets, it is better to use either a discounted cash flow method or relative valuation model rather than using a replacement cost. So generally we see this kind of a mechanism being used for very new kind of companies. The last two are majorly used mechanisms for a private equity investment. The leverage buyout method, especially targeting a buyout kind of investments, whereas a venture capital method is highly targeting at investments in venture capital. So these two methods, I'll take detailed examples to walk you through the nitty-gritties of these methods and the mathematical calculations behind these two methods. So in a simple nutshell, if I want to understand the various approaches that are being used to value private equity private equity investments, I can use any one of these mechanisms, whereas the last two, the leverage buyout mechanism as well as the venture capital mechanism, they are quite heavily used as far as these investments are concerned. So whenever we talk about leverage buyout, now we get into the valuation mechanisms. So I'll talk about the leverage buyout mechanism. Just to summarize, in a leverage buyout, it's also a kind of a buyout, but using a significant amount of leverage. So the acquisition, the buyout, is happening with a significant amount of debt. It could be a senior debt or a junior debt or a mezzanine financing, which is a hybrid between the debt and the equity, part in debt and part in equity kind of mechanism. And because of this huge leverage, probably if the project is successful or if the company is performing well, it can result in higher returns or it can result in higher losses also. So as with the case of any use of leverage, it can be profitable if things are going well, and it can cause a big problem in case things are not going well. And instead of calling it as a valuation mechanism, I look at it in a slightly different way. It primarily determines what should be the maximum price that the PE firm should invest to buy its stake in the buyout firm. So if this is the buyout firm, if this PE firm is looking for 35% stake in this firm, what should be the amount that it has to pay for it? So it will look at the capital structure and various parameters and finally determines that amount. And here, some of the ways that are typically used, the forecasting of the cash flows of the target company, and the PE firm will typically try estimating the exit value as well as exit date. Yeah, if I exit after five years out of this investment, at what, how much times my initial investment I should be getting. So it will use different exit dates as well as the exit multiples to typically estimate how much returns are going to come when it exits the investment at different points in time. So based on that, it tries to identify how much of financing that it requires to invest in that particular firm. So various financial models will be made based on this scenario. And whenever we look at the exit value, at what rate we have to exit, when I want to sell off this firm to someone else, how much, at what price does it needs to be sold off? So it is purely based on whatever they have invested, plus how the company is going to grow over the next over the period of investment, at what rate are the revenues expected to grow. So because the earnings are going to change quite drastically, because of the change in the earnings, what could be the change in the PE multiple, and to what extent the debt gets paid off. Heavier the debt that is getting paid off during this period, the value for the PE firm would become more and more higher. So it is a function, the exit value is typically a function of all these things, which means when I typically look at the growth or the return, it is purely taking into account all these three aspects: at what rate the earnings are growing, at what is the increase in the P by E multiple, as well as at what rate what is the amount of debt that has already been paid off before the exit process. So these things can be estimated with various scenarios to finally understand what is the amount of return that is coming to the private equity investor in this entire process. Let's look at one small numerical on these lines. So evaluating the cash flows of the company, of the portfolio company, the PE firm has thought of investing $100 million today into a portfolio company. It wants to acquire the firm with $100 million, and in the form of most of the capital is raised in the form of debt. So 70% of it is financed with debt, and the remaining in the form of equity. So 70 million in the form of debt and 30 million in the form of equity. Expected exit value multiple 1.5 times the initial investment. So after 4 years, the company is planning to sell off this particular firm to someone for $150 million. Right? So right now they want to get into the deal for 100 million, and at the end of 4 years they wanted to sell it off at 150 million. Not a bad idea, right? Right now it is 100 million. So at the end of 4 years they want to sell it for 150 million. So they are expecting the growth of the company to be around 10.66% every year, which is not a very extraordinary kind of an assumption. So within 4 years they want to exit, and they are expecting that with this kind of operations we can sell off this company at 1.5 times our initial investment, which is at the rate of 10.66% return every year. Okay, then they are also saying of the equity, so 30 million they have invested in the form of equity. Of this equity, 75% is in the form of preference shares by the PE firm. So 75% of this, which is like 22.5 million, it is given in the form of preference shares. It is taken in the form of preference shares. Okay. 20% in the form of equity shares. Okay, they have invested another 20%, which is like around 6 million, right? Around 6 million they have invested in the form of common equity shares. So they have actually invested 28.5 million and remaining in the form of equity shares. So 1.5 million is typically held by the management in the form of equity. So this is how the composition of the equity is going out with. And coming to the payoff, the preference shares are paid at the rate of 15% compounded annual return on the exit. So they have pre-decided how much return they are supposed to get. So what is saying is, whatever is the preference shares, they are supposed to get 15% compounded on their investment. Okay, now let's see the exit value. It is 1.5 times the initial value 100. So typically the exit value is 150 million. Now out of this, how much will the preference shares get? Preference shares are typically going to get whatever they have invested, 22.5 million. They are not receiving anything today. Everything is compounded at the rate of 15% per year over a 4-year period. So the preference shares, they would be receiving 39.35 because they have invested around 22.5 million, and as a part of their investment they are supposed to receive 15% compounded annual return on their exit. And as far as the debt investors are concerned, you are saying, assume that 60% of the debt is paid off by the time of exit, means only 40% of the debt is still remaining. So out of the 70 million, 60% is already paid off during this 4-year process. I am assuming that almost 42 million is paid off. So only 28 million of this debt is remaining. So the debt investors are going to get 28 million out of this. So the equity investors are going to get the remaining. So if I am going to sell off this firm at 150, the preference share guys are going to take 39.35 and debt are going to take this. The equity investors are going to get 82.64. 82.64 million is going to come to this equity investors, and of course 75% so out of these equity, 20% is for the management and 5%. So basically a 4:1 kind of a ratio between the PE investor as well as the management. So PE firm's stake, PE firm's equity stake, out of this entire 82.4, they are going to get into 4 by 5, so they are going to get around 66, and management equity stake, they are going to get into 1 by 5, so they are going to get around 16 out of this. So now these are the various payoffs that are going to come for different parties. So when you look at payoff multiple now, payoff multiple, in case of private equity PE firm, if you are looking at how much they are getting, the benefit they are getting is this amount as well as this amount. This is what is the benefit they are getting for their investment of 28.5 million. So PE firms multiple is almost 3.7 here. And when I look at the management multiple, in the same case, they are getting around 16.5 for only a 1.5 investment, means they are getting 11 times to their investment. This is where the management compensation is highly tied to the performance. They can get this much in case they are able to drive the firm to generate an exit value of 1.5 with the outstanding debt of only 40% remaining at the end of 4 years, and with these kind of deals. So basically if you look at now the return on investment, 3.7 within a period of 4 years. 3.7 within a period of 4 years. So when you are looking at the return which they have got, right, either I can do it as this to the power 1 by 4. So almost 38.69% return. 38.69% return is what is being generated by the PE firm, whereas the management have really generated a very extraordinary kind of a return of 82.19%. So that is what is the benefit the management can really generate if it is able to work out on the business in the same lines as predicted by the PE firm. So the PE multiples are going to increase at this particular rate. So the way I can decide, now I'll work out the reverse. If I say no, if the exit value is only 125, what's going to be the scenario? So there probably the equity is left with only this much. And probably again I can make another assumption, only if 40% of the debt is paid off, means 60% is still left, then these are going to be the return. So basically deciding what should be the exit value will depend on three aspects: at what rate the earnings are going to grow, and what rate the PE multiples are typically expected, what are the expected PE multiples, and of course the exit period, and how much of debt is getting paid off during this period. All these things are contributing very heavily to the deciding of the exit value and the returns to the various stakeholders in the private equity investment process. And here if we see, the management stake is much higher. So if mostly that even that 1.5 million which I am talking of, it would be generally in the form of their compensation is heavily linked with the performance, means they will be given additional shares, or they have the option to increase their stake based on the performance of the underlying. That is what is a motivation factor for the management to work closely with the PE firm in terms of increasing their profitabilities. So this is how we look at the payoff multiples and IRRs for each of these claimants. Now, if I have to understand in what all ways can a PE firm get out of its investments, that is what we call as the exit routes of a private equity transaction. So the PE firm can actually take the portfolio company to an IPO. So this company can be taken public, and the equity stake of the PE firm can be sold to the public. And now that this company is being taken public, probably there is a lot of liquidity associated with it. So a high exit value can very well be estimated. But yeah, sometimes the timing, during what time period, during the time when the IPOs are really successful, or during a very doom kind of a period, during which period is this private portfolio company being taken towards an IPO. If it is taken during a boom period instead of a dooming period, you can expect a very high exit value for this IPO. But overall, it is also more and more liquid, because you are expecting the investments from public. So there is a possibility of getting more and more oversubscription to this IPO, provided this company's performance is very good, which could result in a higher exit value for the PE firm. And it also gives the PE firm a better access to capital, but at the same time the flotation costs and all would be very high in case of an IPO, which could be an additional cost for the PE firm. and generally applicable for the firms which have done very well during the private equity investment stage, which have generated strong operations. For them, exiting the PE investment through an IPO is a much better possibility. Whereas the other way which can be looked at by the PE firm is selling in the secondary market, provided there is some amount of active secondary market existing. Their stake can be sold off to some other private investor who may buy this firm for strategic reasons, probably because of synergy with respect to their line of business, or probably because of this particular firm being a supplier or a customer to that particular company. Various kind of synergies in terms of revenue growth or cost reduction can very well be evaluated, and the other party can very well purchase the stake of the current private equity firm. So such kind of secondary market selling also can result, and if there is a huge demand for this particular company, even that could result in a decent exit value. And the third option is to sell off the stake of the PE firm to the management of the portfolio company itself. So the management of the portfolio company, they may raise a loan and buy off the stake of the PE firm. So because of this transaction becomes heavily leveraged. So though the entire control is with the management of the portfolio company itself, it may have a problem with respect to flexibility because of the stakes of the loan are much higher. So a high compromise cannot be done even in that particular case. And whereas the last mode of exit that can happen in a private equity transaction is through the liquidation, especially for a company which has not performed at all, which is almost hopeless about the future performance, and continuity is a very serious doubtful concern. It's as good as separating out the various assets of the company and selling it off and get the proceeds. So this is the scope of a failed scenario where liquidation can be done, and which can result in a very low value to the PE firm. So apart from how the company has performed, even the timing of the exit is very, very interesting factor. So depending on the timing, the exit multiple can either be very high or even very low. So predicting the multiples per 1-2 years is quite comfortable, because predicting the performance of the company for the next 1-2 years is not so difficult, but looking at predicting the multiples over a longer period is going to be more and more time consuming, or it may not be accurate in any manner also. So these are some of the exit routes that are available in case of a private equity investment. Then we are also looking at the structure of the private equity fund. In most of the cases, what we see is the private equity fund is generally structured as a limited partnership mechanism, wherein we have two sets of people in it. It is registered as a limited partnership. There are two sets of investors. One, the limited partners, who are just investors but no role in the fund management, who just contribute capital but to the fund. So let's say this is the fund. The people who contribute money to the fund, they are all called as limited partners. Their liability is limited to the extent of their investment only. Whereas this particular party, which is the fund, it is responsible to invest in various portfolio companies. So this particular fund is managed by a general partner. So he may also be a limited partner, but this is managed by the general partner, who is a fund manager, who is responsible for the debt which this fund raises to invest in various portfolio companies. So the ultimate unlimited liability lies only with the general partner, but not with the limited partners. That's the typical way a private equity fund is structured. But in some cases, not as a limited partnership, but it is structured as a company itself, limited by the shares. And those shares generally are like a closed-ended ones, wherein the redemption of the share cannot happen until some predefined period. And because it is being incorporated or registered as a company, the legal protection to the investors is much more better in some states compared to the typically being registered as a partnership. So that's how we differentiate a private equity. There are two major types of private equity fund structures. One as a partnership, whereas the second one could be getting registered as a company limited by the shares. But whatever is the mechanism, as a role of a PE fund, it has to raise the funds as well as invest them. So generally the first 1-2 years they spend in terms of raising the funds, and after that they get into the investment mechanism, which will start generating returns for them. And typical duration of the fund will be somewhere between 10 to 15 years, though it can be more, it can be less, but on an average we see the fund will operate for around 10 to 15 years. And as I earlier also mentioned, this regulations wise, this fund is generally available to qualified investors. Probably it may come out as a part of the prospectus that people with a net worth of $1 million or above are eligible to participate in it. So it's not available to every common investor because of the prevalent risks that are associated with this investment. And the terms and conditions with respect to the distributions of profits, or with respect to the payments to the general partner, because general partner is a fund manager, there could be some kind of payments and fees that are needed to be paid to the general partner. So all these terms on how the general partner is compensated and what are the various charges associated with each of the aspects, each of the fund aspects, they are all decided as a part of the negotiation between the general partner and the various limited partners. And if at all the fund is oversubscribed, there is a possibility for better negotiation control to be exercised by the general partner. So that is how a private equity fund structure typically goes like. And some of the important terms that we need to be comfortable with as far as the private equity investments are concerned. Okay, looking at some important fees that get into it. One is the management fee, which is paid on an annual basis for handling the fund. So for evaluating the various portfolio companies, identifying the proportions of investment, buying and selling, all these things, there is an annual fee that is being paid for having a research team in place. For all these aspects, there is an annual fee that is paid, generally as a percentage of the committed capital, or it could be a percentage of net asset values also, which is decided and which is mentioned as a part of the prospectus. So this is not linked to any performance of the fund. Irrespective of the performance of the fund, this charge is typically paid to the general partner. This is more like a fee or a kind of a salary that is typically paid to the general partner. Along with the management fee, there is a transaction fee also, especially for all kinds of services which are being offered by the fund, in terms of raising funds, in terms of negotiating the deals, in terms of selecting the portfolio companies, whatever the transactions that are involved, the GP needs to be paid for all those transaction fees. So and if there is any kind of a benefit that is coming out because of the fee which the GP has received, it is distributed between the limited partners as well as the general partners. So when a limited partner is supposed to receive some portion of this transaction fee, obviously it is deducted from the management fee and the remaining amount is collected. So the transaction fee comes from that standpoint. The interesting aspect is with respect to carried interest. This is basically a kind of a performance based fee for the general partner. The share of profits. So if at all, let's say the fund, we are promising that this is the amount of invested capital or this is the amount of committed capital, and the fund has outperformed this by certain amount. Once the targets are crossed, what it says is, if you have crossed the target, above the target you can receive a performance based fee which is called as the carried interest. So generally it would be 20% above the 20% of the profits that are generated by the fund is typically being paid as carried interest, but of course there could be some kind of restriction. This carried interest is paid only after this much of target is being met. We'll discuss about that. So the carried interest basically is a share in the profits that is typically being paid to the general partner for the performance of the fund. Then the other important term that is worth understanding in case of private equity investment is the ratchet, which is in what way is the equity typically allocated between the portfolio company and the PE firm. So let's say the PE firm has invested in this portfolio company. How is the equity distributed between this company and the PE firm? And in what way this management can keep increasing their stake based on the performance. So if the in the earlier numerical we have seen that they have a scope to increase their stake in case the performance of the company is going to be higher and higher. So that is what we call as a ratchet. Initial allocation of the equity between the PE firm as well as the management, and how that stake can be increasing over the period based on the performance of the company. Then we also use a term called hurdle rate, which is like a target. What is the minimum IRR the fund has to generate every year for, beyond which only the carried interest will come into picture. Until that time, so unless the hurdle rate is crossed, the general partner is not eligible to receive the carried interest. Apart from that, we see a few more terms like the target size of the fund, which is to what extent the general partner is having the ability to raise and invest funds. It talks about the potential of the general partner. And at the same time, we keep hearing of terms like vintage, which talks about the year in which the fund was started, which can be helpful in terms of comparing various funds. And coming to the various corporate governance aspects, there are important clauses that are there as a part of this PE firm deal. One is called as a key man clause, which talks about, let's say the general partner has hired one strong analyst who is heavily a key person for this general partner, whose role is probably evaluating the various portfolio companies and then investing in them. Let's say if this person leaves the company, we say the key man clause will get applicable there, and the deal says the GP firm cannot do further investments until a suitable replacement for this person is found. That is what goes as a part of the key man clause. Then the agreement also can contain the disclosures as well as the confidentiality, what needs to be disclosed to the limited partners, especially the fund performance on a quarterly basis or a semi-annual or an annual basis needs to be disclosed. But the composition of each of the portfolio companies, the performance of each of the portfolio companies, the in-depth details of each of the portfolio companies can be confidential, need not be disclosed. So as far as the overall fund performance is concerned, yes, it may have to be disclosed, but the in-depth performance of each of the portfolio companies need not be disclosed there. Then the agreement also has a clawback clause. It's a very interesting clause. Let's say the GP in 1 year he has generated good profit, and because he has generated good profits, he has received the carried interest, which is, let's say, 20% of the profits that are generated. Now in the next year or in the next couple of years, he has generated losses. In case he has generated losses, the clawback clause, what it says is, because he has already received some profit earlier, he has to pay back. He has to pay back the proportion of the profit corresponding to this loss. In case he has received the carried interest earlier because of the profit generated, the clawback clause simply says he has to pay back a portion of that profit in case the fund has generated the losses subsequently. And what we generally see is the net asset value is a mechanism that is generally used to value the fund. Yeah, this is an interesting term, the distribution waterfall. How are the profits distributed to the LP and GP? I mean, when I say GP, the profit distribution could be with respect to carried interest payment, whereas with respect to LP, it is getting a portion of the invested capital as a part of the return of capital. It could be in the form of dividends or whatever may be the aspect. So this talks about the mode in which the profits of the investment are distributed between the LP and GP. So there are two major methods that we talk of. One is a deal by deal method. Deal by deal method probably benefits the general partner, but it may not be of a good benefit to the limited partner. The deal by deal method, as the word itself is saying, the general partner receives the carried interest on a deal by deal basis. So if one deal has generated, if one investment has generated some profit, 20% of the profit goes to the general partner. Another deal is generating a loss, probably in some cases it may, if it has a clawback provision, some portion of the loss may have to be paid back. But even though it may so happen that even though the overall portfolio has not generated enough profit, it is very much possible that the portfolio, the general partner is able to make some carried interest in the deal. So it has to be very carefully evaluated, and the benefit mechanism need to be designed if at all we are going with a deal by deal kind of a mechanism. Whereas on the other side, there could be a total return method, whereas where the carried interest is actually computed not on a deal by deal basis, but it is computed on the overall portfolio. But in this also there are two methods. Though the carried interest is calculated on the overall portfolio, this puts a rule saying, yes, the carried interest will be paid after the entire committed capital is returned. Only after the company has generated the entire committed capital, or it can go with the other way, the portfolio value is greater than the invested capital by some amount. Let's say invested capital is 100 million and it says, okay, portfolio value greater than 20% or 120% of the invested capital. 20% more than the invested capital means if the portfolio value has gone beyond 120 million, the portfolio manager is typically eligible, the general partner is typically eligible to receive the carried interest. So in the total return method, we are computing the carried interest not on a deal by deal basis, it's on the entire portfolio value. So that is how the distribution of the profits happen between LP and GP. As we have already seen earlier, to align the interest of the management with the portfolio, with the PE management, with the PE investors, there could be a tag along, drag along kind of a clause which says any acquisition offer that comes to the portfolio company, it has to be extended to the PE firm as well as the management in the same manner. And along with that, the agreement can have a few more clauses like no fault diverse clause, wherein more than 75%, which is a super majority vote of LP, can be used to remove a GP, or even if there is no 75% of the LP vote, by showing a cause the GP can very well be fired. Along with that, this particular deal could have terms, and it can also talk about some kind of restrictions with respect to the usage of leverage as well as the level of diversification that can be done. All these things can come very comfortably as a part of the private equity fund agreement. As also there could be a co-investment kind of a clause which says the LPs can very well invest in the other funds of the GPs with almost negligible management fees, which can prevent the GP from mishandling the funds, using the proceeds of the fund to invest in of multiple funds to invest in the same portfolio company, or probably using one fund to invest in a portfolio company which went into a loss through another fund. All these kind of things can very well be generated as a part of the prospectus of the private equity investment, which has to be thoroughly evaluated and then invested with proper due diligence. So just looking at one numerical, we have invested a capital of 100 million where the committed capital is 200, means uninvested portion is the remaining 100 million. The carried interest to the GP is 20% of the profits. So in the first year, let's say a profit of 25 million is generated. So if at all I am going with a deal by deal method, if at all I go with a deal by deal method, let's say if I am saying 20% of the profit, because I have generated 25 million in the first year, 20% of that 25 million, which is 5 million, is paid to the GP, because it's a deal by deal kind of a method. But if I am talking about deal by deal, if I am talking about the total return method, the total return are how much? 25 million plus investment of 100. So 125 million is the total return that has come, right? The total capital that has come is only 125 million, whereas the committed capital is 200, because the total portfolio value did not exceed the committed capital. No carried interest is typically paid. Whereas in the next, let's say total return method itself, where the portfolio value exceeds the invested capital, let's say by 20%. So 120 million is the requirement. If the portfolio value is more than the 120 million, in this case 125 million, so portfolio value is more than the invested capital plus 20% on the top of it, which is 120 million. This is 125 million. Carried interest can be paid, and if at all the carried interest can be paid, it is paid on the excess. So 25 million is the excess, So 25 million. So 25 million into 20%, again 5 million is being paid to the GP. So in whatever, if even though it's a deal by deal method or even the total return method, method number 2, wherein the carried interest is paid if the portfolio value exceeds the invested capital by, let's say, some predetermined 20%, rather than saying portfolio value exceeding the committed capital. And in case, when I apply the second year now, there is a loss of 5 million. So because in the deal by deal method, the GP has taken 5 million, the loss is 5 million. So 20% of this 5 million, which is 1 million, as a part of the clawback provision, the GP has to return that $1 million back to the fund. Right? Because of the clawback provision, the GP has to return 1 million back to the fund. Wherever he has received the 5 million, if at all there is a clawback provision, he has to return back 1 million to the fund because of the losses generated, and the GP has already taken his carried interest for the profit that has already been generated in the earlier period. Now that we have talked about the value of the fund can be assessed using the NAV approach, there are different methods which are typically used to find the NAV here. Sometimes companies use the initial cost of the investment plus additionals, whatever the new fundings that come or any devaluations that have happened, some kind of adjustments happen with that. Otherwise, the initial cost plus no adjustments until the exit. All these things, okay, in this case the market value of the portfolio is not known until the exit, right? Because we are not able to assess the worth of various portfolio companies, right? As a part of the disclosure, only the fund value can be disclosed, but not the performance of the underlying portfolio companies. So until the exit, the performance of the portfolio companies is not known, which means the value of the value of the assets is not known till the end, and revaluation of the fund can happen only when there are subsequent rounds of financing. So for a company where there are no additional financings in the middle, valuing the firm may not be an up-to-date mechanism at all using the NAV, because the NAV is very difficult to determine in that kind of cases. Similarly, we can use discounted factors for restricted securities, and most of them, they have an illiquidity being associated. So illiquidity associated discounted factors can be used, but the illiquidity percentages can be determined based on the equivalent comparable publicly traded companies. And in the computation of the NAV, generally the undrawn capital commitments are not included, whereas from an LP's perspective, they are liabilities, because at any point in time the GP can withdraw those funds and use them for the investment. So it is an undrawn capital that is right now, it's not going into the computation of the NAV. And what is the value of that undrawn capital completely depends on how much cash flow can be generated out of it, which is quite uncertain. And at the same time, what we are seeing in the calculation of the NAV is different at different stages. Companies are using different mechanisms which are listed above for valuing for coming out with the NAV. In some cases, only the cost mechanism they are using, but as the company is growing, as the industry is, as the company is growing, and as it is becoming more and more matured, probably the revaluation mechanism is getting used, or multiples based mechanism is being used. So different value mechanisms at different stages of the life cycle also makes it difficult to find the real value of this private equity investments. And most of the times what we see is the value is generally determined by the general partner, but when limited partners are going to find out the NAV, typically they may engage a third party to do this process for them. And if I have to look at key differences between a private equity investment versus a public equity investment, in a public equity, whatever the capital that is being committed, everything is invested immediately. Whereas in private equity, there are two different things. The investors, the LPs commit this much of capital. So the GP says this much of capital needs to be invested from your side, but the drawing portion of the capital can be at different points in time. So the drawdown periods could be completely different. Drawdown, so the GP can draw them at any point later and further use for the investment purpose. So whereas in case of public equity, whatever the capital that is committed by the investor is invested pretty immediately into the various investments. And returns can have various patterns here, whereas in a private equity investment, even though it's a successful private equity investment, it is observed that the returns generally follow a J curve. Initially there could be losses, but after that the profits will start getting generated. This is what is a typical J curve that is being talked about. Most of the private equity investments, it is seen that the returns follow a typical J curve. And typically compared to a public investment, the private investments are treated highly risky, so only available to qualified set of investors or highly net worth individuals kind of players only. Coming to the various forms of risk that are associated with private equity investments, they are exposed to liquidity risk, because most of the private equities are not traded. Active market may not exist for most of the private equity investments, so obviously they are exposed to a liquidity risk. And because they are not publicly traded, there is no publicly determined price associated with the PE investment, which means the unquoted price risk or unquoted investment risk typically exists because there is no quoted price associated with it. Then we also talk about the competitive environment risk, because finding suitable private equity players who are reasonably priced is not that easy. Means we are exposed to every investor is exposed to a competitive environment. Probably most of them may be overpriced, but you don't have any other alternative, which means as an investor you are exposed to competitive environment risk. There could be agency risk between the managers of the portfolio companies and the PE investors, just like a principal agent problem that can exist in public equity investment, because the managers of though there are so many mechanisms we have seen where the PE firms try to control the portfolio company managers, but there can still exist some level of agency risk between the managers of the portfolio company as well as the PE firm. There could be a capital risk, especially with respect to the subsequent rounds of financing, especially when they are very difficult to obtain. Getting enough capital to perform the next level of business operations is going to be very difficult. And any extraordinary government regulation that is coming up will have a very big impact. Any big tax change that comes up may have a very big impact on the private equity investment. And as we have seen, the various methods of valuation, determining the NAV is very difficult, there's a lot of uncertainty going into the process. The valuations are not that easy for a private equity investment. Neither the DCF model works well, nor the relative valuation model works well. So because of that, there is going to be some level of uncertainty or risk that is involved with respect to the valuations. And it is very much possible that a PE investor may not diversify that comfortably, or probably the PE firm may not diversify that heavily, which means it becomes the responsibility of the limited partner to choose the various PE firms so that they are very heavily diversified, because one single PE firm may or may not diversify its risk quite comfortably by investing in various portfolio companies, and there could be a market risk involved in this particular transaction, especially which gets affected with very long term changes to price, interest rates and all these things. And they are very heavily exposed to the investment strategy risk as well as the country or regional kind of risks also. And coming to the various costs, you see, we have already seen the management costs which are paid on an annual basis to the general partner. There is a carried interest based on the performance of the general partner in terms of generating the profits. There are transaction costs which are associated with due diligence performances, the financings and all these costs. Every fund has an initial setup costs, administrative costs which happen on an annual basis, especially with respect to the custodian costs, the audit costs, the accounting costs, a lot of these things. And there is a dilution cost that comes to the PE investors, because the management of the portfolio companies, they have options to increase their stake in the company, which means it's a cost to the fund management, the PE firms. So even that has to be treated as a cost. And let's say during the time of raising capital, the parties who are being engaged for the purpose of capital raising, they charge a placement fee, which could be an outright upfront amount, or it could be charged on an annual basis based on the amount that they are contributing to the raising. All these things are various costs and risks that are associated with the PE investment, which has to be evaluated very critically, and an appropriate due diligence need to be performed by the PE investor before deciding on which particular PE fund to choose for the investment purpose. And how do I measure the performance of the various PE funds? The Global Investment Professionals Performance Standards, CHIPS, it recommends use IRR for this process. But again, the point that needs to be understood is, should a gross IRR or net IRR be used? So it depends on what perspective I am looking at. If I have to use gross IRR, it is nothing but from the perspective of a PE firm to the investments in the portfolio companies. So the PE firm has invested this much in various portfolio companies, and at the end of 1 year, these are the returns that have come up. So this is a measure of, so what is the return that has come up during the process? That is what is gross IRR. So it talks about the effort of the general partner in terms of extracting the returns out of the investments in the portfolio companies. It is not the return which the LPs are getting, because out of whatever this has come, the management fee will be deducted, the carried interest will be deducted, any other administrative costs will be deducted, and only the remaining amount goes to the LPs. So this return, what the LPs are getting for whatever they have invested, is what we call as the net IRR. It is that return which exactly is received by LPs after the subtraction of the various costs that are involved in the investment process. And in some cases we use various multiples to compare the performance of various PE funds, because these multiples, they actually separate out the realized versus the unrealized returns. So how much of the investment is redistributed back to the LPs, which is the realized return, how much of it is not redistributed to the LPs but it is held in the form of various holdings with the GP. So that is going as a part of the unrealized return. So to typically compute that aspect, we get into the things like paid in capital, which talks about out of the total committed capital, how much of it is typically being used by the GP for investment purpose, which is called as a paid in capital. Then another ratio is being looked at, the distributed to the paid in. Okay, out of this much that has been utilized by the GP, how much has been already returned to the LP. That is what is talking about the distributed. Whereas the receipt, so this is otherwise called as DPI, distributed to paid in. Then we have residual to paid in capital, which talks about how much of it is still undistributed, which is in the form of various holdings in the fund. And finally, it's also talking about the total value to the paid in capital, which is generally expressed as a summation of the realized return as well as the unrealized return, the DPI plus RVPI kind of mechanism. All these are various tools that are typically used to evaluate the performance of the various PE funds. So what we can typically look at is, we'll look at one small numerical to work out what are the numbers, all these things whatever we have discussed, how much are they getting evaluated to, and how do I typically compute the DPI, RVPI and various other performance metrics of the fund. Okay, so let's look at this numerical to evaluate this process. The total committed capital is 325 million. Alright. Out of that, the undrawn portion is only 25 million, which means 300 million of the committed capital is already drawn. So what is the paid in capital here? In this example, I can very well say that the paid in capital, which is 300 million, which is used by the GP out of the 325 million. So almost 92.3% is the paid in capital for this example. The drawdown is happening in the ratio of 1:2:3:4:5 in the last 5 years out of that 300. So probably let me work out in terms of the drawdown. So I'll say year 1, year 2, right from the old. Year 1, 2, 3, 4, 5 in the last 5 years. Right? So drawdown, it has happened in the ratio 1:2:3:4:5. So 1/15 times the 300 is allotted in the first year. 2/15 times the 300, which is 40 million, is allotted in the second. 3/15 times the 300, which is 60, is allotted in the third. And 4/15 times the 300, which is around 80 million, is allotted in the fourth. And 5/15 times 300, which is 100 million, is allotted in the fifth year. So based on this, I can find out my paid in capital each of the years. Paid in capital here is 20 million, whereas by the end of second year, the paid in capital has become 60, and like that it has touched 300 million. So percentage wise, it is 300 million out of a committed capital of 325 million, resulting in around a 92% usage. No issues. Now comes, what are the other aspects? The management fee is 2% of the paid in capital. So I will say management fee 2% of the paid in capital. So this is the paid in capital. So the management fee in each of the years is coming out to the 2% of the paid in capital. So in each of the years, the management fee is coming out to this particular number. So in each of the years, if I have to compute the management fee, it is around 1.2 million in the year 2, 2.4 million in year 3, and so on. So this is what is the management fee working out to. Then the carried interest is 20% based on the total return methodology. Okay. So the 20% of the total return. So we'll work out with the total return. So we'll take up the total return, and we'll try to compute. The carried interest, which is exceeding the committed capital itself. Now looking at the operating results for each of these years, what we are seeing is 50% of the paid in capital loss in the first 2 years, followed by $45 million improvement in the performance every year from then onwards. 50% of the paid in capital loss for the first 2 years. Okay, so I'll say the profits per the year or operational results or the profits per the year. What I am saying here, 50% of the paid in capital, that is a loss. So 50% of the paid in capital. So 10 million is the loss in the first year, and in the second year 50% of the paid in capital, 30 million is the loss, followed by a $45 million improvement in the performance from that year onwards. So I'll add 45 to each of the years, thus resulting in 15 million, 60 million and 105 million being the profits in each of those years. So those are the profits for the year. Now based on this, I can very well compute the NAV before the distribution. NAV before the distribution, initial paid in capital minus the management fee plus the operating results. So this is what is the NAV for the year before the distribution. And of course here based on the NAV only, the carried interest will come into picture. And of course what is the carried interest mechanism in this case? 20% based on the total return method exceeding the committed capital. So the committed capital is 325. Only when the NAV is greater than 325. In case the NAV is greater than 325, then only the carried interest will be given. Otherwise the carried interest will not be applicable. So in this case obviously there is no carried interest. And again we look at the distribution, how much is being distributed to the limited partners, and after that I can look at NAV after distribution, right? So in this case there is no carried interest, there is no distribution, so my NAV after distribution is a subtraction of all these numbers. Fair enough. Now from the second year onwards, what will happen? If I have to find out NAV before distribution, I am finding out what is the NAV at the end plus whatever has been brought down for this year minus the management fee plus the operating results for the period. So this is what is the NAV before distribution in each of the years, and when it comes here, I'm looking at the NAV minus carried interest minus the distribution. So working out to this particular number here, and as an update, these are the numbers that are coming out. Then I need to work out on the carried interest as well as the distributed money. Let's see what are the carried interest is 20% based on the total return method, 20% of the total return exceeding the committed capital. So the committed capital I have taken it as 325 million. So anything exceeding the committed capital is what we take as carried interest. So here only in this year there is a carried interest that is getting applicable, right? So for that also I can write it as, if this is greater than 325, I'll talk about the excess. So because probably what I can do in case of carried interest is only in this year, the carried interest applies that to 426 minus 325, and there is a 20% that is applied on the top of that. So carried interest which the general partner is receiving is somewhere around 20.2 million for the performance in year 5. Then distribution of profits, 25% of the NAV before distribution every year once the NAV crosses the total committed capital. So which means here only there is a distribution of 25% of the NAV before distribution, right? So this is the NAV before distribution, so 20% of that, 25% of that is distributed, which is resulting in this as the flow for the 5-year period. So this is how we are able to prepare a sheet containing the performance of the PE fund, and based on which how the results are getting evaluated. Now on these lines I can very well say that finally the NAV after the distribution is ending up with 299.3 million, and similarly I can try finding out for each of the years what is the NAV before. So we need to understand here, if at all I have to find out NAV before distribution, all we are saying is whatever was the outstanding NAV as of the previous period, to that I will add the committed capital in this year, or probably drawdown capital for this year, and on that I will remove the management fee and probably add the operating results of the year, profit for the year, which will give me NAV before distribution, and out of that if I subtract the carried interest along with the distribution to the limited partners, that is what will give me NAV after distribution. These are the calculations that we are doing in this process. Now I can very well find out, okay, to what is the total management fee here. I can add up all of them, right? Now everything is with me. So the total management fee in this process is going to be around 14 million. The total carried interest is somewhere going to be around 20.2 million. And the amount that got distributed within this 5-year period is somewhere to the extent of 106 million. And when I want DPI, which is the distributed to the paid in capital, okay, what is the distributed amount? 106.5, right? So I can calculate all those ratios. So DPI, which is 106.5, that is the total amount that has been distributed till date, divided by the total original invested, which is like the paid in capital as of late, the paid in capital. So almost 35.5% of the capital has already been refunded back as a part of the distribution. Whereas if I want RVPI, which is residual value to paid in capital ratio, I can look at the final NAV, whatever is there, which is still like not yet distributed. So the final NAV divided by the total paid in capital is what is coming out as RVPI. Almost 99.7% of the total capital invested is in the form of the assets held with the general partner, which is yet to be harvested. And finally, when I say TVPI, total value to paid in capital, I can do a summation of these two things, saying the return wise, it is expected that this entire thing over a period of 5 years, right now it is generated around 35% return, including the distributed as well as undistributed kind of profits. So this is how the typical performance evaluation. Now if I have another PE fund, I can compare the two funds on the lines of their DPI, RVPI as well as TVPI kind of numbers by making a table or by making a schedule which talks about the NAV before distribution and NAV after distribution. This is how we compute the performance of a private equity fund. All right. Okay, let's move on to the next one, wherein our intention is to find out the value of the investment going with a venture capital method. If at all I am using the venture capital method to evaluate an investment, how do we really take into consideration? And for that, what we are saying is there are two important terms that are used. One is the post money value and pre money value. And for that, what we are saying is, okay, I am thinking of investing some amount at this point, right? I am thinking of investing some amount at this point and I want to exit somewhere at this point with some kind of an approximation. I want to invest some amount X here and I want to exit somewhere here. And at the time of exit, I am thinking of some particular value. I want to exit at some 300 million. So I want to sell off this company, let's say after 5 years, for 300 million. So based on the some rate of discount, based on the risk associated with it, I will discount it and bring it down to the present value. So that present value is called as a post money value of the investment, right? Whatever is the estimated exit value, I bring down to the present value by using an appropriate discounting rate, which is what I am calling as a post money value of the investment. And because I am investing X at this point, whatever the present value, let's say Y is the present value of 300 million. So the post money value is Y, and Y minus X, X is the investment for me. Y minus X is what I call as the pre-money value of the investment. Before I invest, that is the value of that particular investment, of that particular business. So because I am investing the X in it, the fraction of ownership which I need to get in that particular company is I am investing X for the company which is having a value of Y. For a company which is expected to have a value of Y, I am investing X. So X by Y should be my proportion of shares. 1 minus X by Y should be the proportion of shares of the owners, of the original owners. So X by Y should be my proportion. 1 minus X by Y should be the proportion of my owners. So if my owners are already having some number of shares, this is the number of shares of my owners. So 1 minus X by Y is the number of shares of my founders, right? One minus X by Y into the total shares. See, 1 minus X by Y is the share of my owners. Then what should be my share? So that is what I am trying to go with. Existing shares of the founders. So if 1 minus X by Y shares belong to my founders, obviously F by 1 minus F should be my proportion of shares, because X by Y denote my proportion of shares, whereas 1 minus X by Y denote the proportion of shares of the owners. So if at all I want to find out the number of shares which I need to get, I take the existing shares of my founders, multiply it by F divided by 1 minus F, which is nothing but F is X by Y, 1 minus F is 1 minus X by Y. So if my owners, which are 1 minus X by Y, are having some P number of shares, right, are having P number of shares, then as X by Y, how many shares I should have? I need to have 1 minus P number of shares, because my proportion is X by Y. And at the same time, the other way I should look at it is, if 1 minus X by Y shares are equal to P and my share is X by Y, so X by Y should be equal to 1 minus P. So proportion of ownership wise, I should be having P by 1 minus P kind of a proportion of ownership of the total share. So that is what I am using to find the shares that a venture capitalist would be getting as a part of this investment. And based on that, if he is finding out how much amount he is investing and dividing it by the number of shares, you can arrive at what is the price per share. That is what we call as the venture capital method of finding out the value. But here the thing that we need to consider is there are two methods. What if there is only one round of financing versus multiple rounds of financing? How do I typically evaluate the worth of the share or worth of the investment especially if there is only one round of financing versus the multiple rounds of financing, but the process always remains the same. For that, let me look at a small numerical. I am trying to get into a venture capital investment in a firm whose exit value right now they are thinking of investing 20 million in that firm, right? A new investment of 20 million is required, but the founders are projecting that the firm would be worth 100 million in 5 years, and the shares of the founders are around 1 million. Okay, not $1 million, 1 million shares are there for the current founders, and they have applied a discount rate of 35%. So based on this, if I have to find out how many shares the VC would be getting and what is the price per share, we can look at doing these basic calculations. Okay, exit value, in this case it is being said exit value is 100, exit duration we are saying is 5 years. So the post money value I can very well take it as 100 divided by 35% is the discount rate that is being taken because of being a risky project. 35 to the power 1.35 to the power 5. So the post money value is coming out to 22.3 million. Right, the post money value is coming out to be 22.3 million. So what is the pre-money value here? Remove the investment. 20 million is the expected investment that is going to come. So the pre-money value is only 2.3 million. So because the pre-money value is only 2.3 and the investors are already and the founders are having 1 million shares, I can very well find out the fraction of ownership. Fraction of ownership of the VC, which is coming out to investment divided by the post money. So VC is having almost 89.6% share in the investments here. Almost 90%, 89.68% is the fraction of ownership for the VC. And in case I am talking about the number of shares that would be coming up, it is because the founders are having 1 million shares. I'll take it as 1 million multiplied by the fraction of ownership of the VC divided by 1 minus the fraction of ownership. So the VCs would be getting almost 8.69 million shares. So overall 8.69 plus 1, 9.69 million shares are there for this particular company, and based on this the price of this share is working out to the total investment by total number of shares. So the total investment is 20 million divided by the total number of shares, which is working out to almost 2.30135. That is the total number of that is the total price per share as a part of this particular process. And now instead of a one period approach, instead of giving all 20 million today, if the mechanism changes slightly, if the venture capital company thinks, no, these guys don't require 20 million today, I'll fund 12 million now and 8 million after 3 years. Probably after 3 years the operations become more and more steady, the risk comes down, so the discounting factor also probably might come down. So that is where instead of taking 35% discount rate, for the last 2 years, let's say I am applying only 25% discount rate. Based on this, I want to see what is the kind of value that is coming out, and probably what is the number of shares and the share price that is going to come out in this entire process. So if I change this slightly, right, so I'll say the post value, post money at the end of the second, for the second period, let's say the post money I want to find out. In the second period, 8 million is being paid, right? I'll break the problem into two pieces. One is only for the first period investment, the other one is for the second period investment. In the second period, 8 million is what is expected, whereas the discounting rate is 1.25 because 25% is the discount rate for the second period. So when I am discounting it for 2 years, which means at the end of 3 years, the expected value is 5.12 million. The post value, the post money value at the end of 3 years is going to be 5.12 million. So the pre-money at the end of 2 is the post whatever has come, right? Here I have to look at the exit value first of all, not the investment is 8. What is the exit value? Exit value is still 100 million, right? So I am taking not 8 million, 100 million. Let's say I am discounting it by 25%, it is coming out to 64 million. So that is the post money value. The pre-money value will come out as the post money minus whatever is the investment that you are bringing in. 8 million is the investment that you are bringing in. Okay, one more zero has to come, 100 million. So 8 million is the investment that you have brought in, which means the pre-money value at that point is something like this, which is now resulting in the fraction of VC ownership at that point is going to be whatever is the 8 million divided by the post money value at that point, which is going to be around 12.5% is going to be the value of the fraction of the VC ownership extra that is coming out for the second round of investment. Now, so the pre-money value is going to be this much. So based on this pre-money value, I can find out the post-money value at the end as of today for the first 3 years, based on the first 3 years. So whichever is the pre-money value at that point in time, I'll discount this by 3 years, which is telling me that this is the post money value at the end of one period, or which means as of today itself. And whereas in this case the pre-money value, the investment is only 12 million now in the first phase. So if I remove the 12 million, the pre-money value is this much. And for the first phase, if I want a fraction of VC shares, for the first period, the fraction of VC share, the initial investment, which is 12 million divided by the post money value, which is going to be this. So the VC share initially is going to be somewhere around 52% or close to 53%. Initially the VC share is going to be 52.72%. Based on this, the total number of shares which the VC is initially going to get is, initially there were 1 lakh shares, or 1 million shares multiplied by F divided by 1 minus F. So this is telling me that the VC is going to get around 1.115 million shares in this transaction. So based on this, if I want to find out the price at the end of our price for the first period, it is coming out as the investment amount, which is 12 million divided by the number of shares. So in this case, it is working out that the share price is around $10.76 per share. Now from the second transaction, the total number of shares that are there. So total shares now at the end of the first transaction is these are what VC is getting, and 1 million is what that are already existing with the founders. So these many shares are there in the market for that particular security. So number of shares based on the second transaction, right? Number of shares. So I'll say shares based on the second. So again the same, total shares multiplied by the fraction of the venture capitalist minus 1 divided by 1 minus the fraction. So almost 302,000 additional shares are getting issued, and this time what we see is the price as of the second case, whatever has been invested 8 million divided by the number of shares that he has received. So the share price in this case is becoming $26.47. And after the second round, whatever the first round shares, whatever were the first round shares, they were diluted, right? Because on this shares I am taking F by 1 minus F. So what you are seeing is, now if you look at the total number of shares that are existing, or proportion of ownership that is existing. So when you look at this dilution of ownership here, out of this 52.72%, almost this 12.5% is diluted, which means because even out of this 52.72, some shares have been allocated for the second round. So it's not a summation of these two things which is the total proportion. This will become, the total proportion of shares will become F1 into 1 minus F2, because we have multiplied the total number of shares and then used that into F by 1 minus F, which means whatever the dilution that is happening, it is happening to the original owners as well as the first the first layered venture capitalists. So the 52.72% stake of this party is actually becoming only 46%, 46.13%, and 12.5% belongs to the second round venture capitalists. So if both of them are the same, probably the stake has gone up from 52.72 to 58.63% if the funding is done in this kind of a mechanism. So depending on whether the funding is getting done as a one round of financing or multiple rounds of financing, the stake of the ownership will keep for the venture capitalist firm will be differing. Alright. So but here one catch that is there is, these numbers generally are presented by the founders. This is a very big gamble, and this is a big gamble, the 35% discount rate that has been taken. So these are always risky things. So what is generally done by the VC firms is they do some kind of adjustments for taking in making sure that whatever they are investing is in the right direction for them, or probably they are taking into account the probability of default that can occur in any particular year. So to account for that, there are two mechanisms they generally work out with. One, they adjust the discount rate. So let's say someone has said 35% is the discount rate. Let's say the original founders have come out with a plan saying that 35% is the original discount rate. The VC, if he really wants to make some adjustment to this, all he can do is he can adjust this rate by multiplying it or by dividing it by 1 minus q based on the probability of default. So if I assume that the probability of default in a year, let's say, is around 20%, what he can do is the adjusted discount rate can be used as 1 plus 35% divided by 1 minus 20%. So he can use around 68% as the discounting rate in case it is assumed that the probability of default in a year is going to be somewhere around 20%. Or if you are saying the probability of default is going to be around 10%, then probably this can work out to somewhere around 50%. So that can be used for finding out the post values and the pre values and then working out. That is one way typically the venture capitalist firms make modifications to find out the present value and hence use that as a part of their negotiation process. The other thing what they do is they adjust the cash flows reflecting the probability of failure. Okay, each year, if at all the founder has projected that $100, each of the years the revenues are going to be some X, and what these guys do is instead of taking revenues as X, they take only 0.8X, which means even if they have forecasted a cash flows of X, we take each of the cash flows, let's say, by around 0.8x, assuming there is a 20% chance of default. So adjusting the cash flows of each of the years and after that doing the present value of the future cash flows. That's one more way that can be done. The same way the terminal value also can be adjusted. So here they have projected that 100 million is the exit value. Simply, if I assume that 20% is the probability of failure where nothing can come, only 80% chance of getting this 100, or if there are some more intermediate mechanisms, simply the workout will happen as, okay, why not I make it 80 and check it out. If I am making it as 80, probably the investment, whatever the 20 million I am making, it is resulting into a loss. A quick workout will tell me if the investment is going to give me 80 million, if the exit value is 80 million at the end of 4 years, obviously it's of no use. It does not work out in my case by if I am giving 20 million altogether. But if I am giving for 12 and 8, probably it is working out. But yeah, I have to really look at, instead of 100 million, let's say I am going with 80 million. Okay, here also I'll just put 8 million as an investment. So the fraction also I will take it as 8. So the post money value is going to be this much, which is resulting in a pre-money value. Here also I should take out this if I am making it into 12. the fraction of the VC also I will do the same. So 68.34% is the fraction of the venture capital that is coming out, which is resulting in 57.67 even after the dilution. So probably if 12 and 8 are there, still things are working out. But if 20 has to be invested in one single go, it's not working out. So the VC firm can very well evaluate by just changing either the discount rate or changing the terminal value based on the probability of failure, or they may consider, okay, there is a 20% chance that no cash flow can, no exit value can come because in the middle itself the project will be a flop. There could be a 30% chance where probably the exit value is going to be some 50 million, and there is a 50% chance where the exit value is going to be 120 million. So even an expected value of the same can be taken and then incorporated here to evaluate the model. So all these kind of things are very well possible as a part of risk management strategy typically taken by the venture capitalists. So that is how we are going to look at the evaluation of the venture capital investments. So in a nutshell, in this session we have dealt in great detail the private equity investment, the basic understanding of the conceptual aspects of private equity investments, and how the typical valuations happen using various methods, and how the ownership proportions are computed in each of these aspects. I hope all these things have given you a decent level of insight into understanding of the private equity based calculations and concepts. In case you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@peacegurus.com. Thanks a lot for listening to this session. Thank you very much.